Yeah, it's really tough. I mean, you're at a point where the ability to build new anything is tough because construction costs are still very high. Market rents are soft in everywhere, maybe with the exception of retail, where you're seeing there's been shortages of retail, so you're seeing retail rents. I hate to use the word spike, but in some markets they're going up just because of the shortage.
Beyond the Blueprint podcast, welcome back to our second episode with Josh Harris. I'm your host, Branson Bowen, and today we're going to jump into, first to start, the state of the economy. Where are we at? We're here in 2024. There's been a ton of changes in the past, 3 years or 4? There's a lot of uncertainty right now. People don't know if we're going into a recession, right? If we're going into a correction. Yeah. We've got an election coming up that's going to impact some stuff. We've got interest rates that are pretty high. So what's going on?
Boy, it's always an interesting question, and I should timestamp this just for anyone who's watching that we're recording this. It's just about early mid-March of 2024. So, all my, the lifespan of any of these statements might be an hour at this rate in this day and age. I will say that you really want to pray for worlds where the economist is the most boring speaker in the room. Yeah. When the economist is the exciting speaker, things are usually not good. And I feel like economists are kind of exciting right now. And so obviously the biggest sort of story of this period we're in was COVID, right? I mean, COVID and the resultant lockdowns and disruptions and everything it caused sent the economy into a really weird space. And my own belief of how to best describe it, which is something that I will candidly admit, I'm not sure if a lot of policymakers or sort of even the more traditional macroeconomists sitting with their models maybe fully appreciate, is that the better analogy for what COVID was is a natural disaster, right? And look, we're in Florida. Hurricanes come, and the Bureau of Labor Statistics, a lot of people do this. They understand that, like, if a hurricane is threatening an area, everything shuts down. So, like, unemployment, if it happened to be during a survey window, would skyrocket, right? Literally, there could be suddenly 200,000 people who are just not showing up to work, so they're re-registering as unemployed. And they'll make a note on this. It says, oh, by the way, don't really pay attention to that. That's just this area was being threatened by a storm, so don't pay attention to this loss of 200,000. Oh, and by the way, next month, when everything just reopens, but for maybe the small area that actually got impacted by the storm, don't count that as real job gains either, right? They should just wash out. But we know this. We know what to expect. COVID is very similar, right? The government, not even before the candidly, we all just stopped doing stuff. That was one of the jokes. I mean, lockdowns were, maybe they persisted too long, kind of, in various opinions, mine included. But we all stopped moving before we were told not to, and restaurants were closing anyway. So that was a natural disaster, just that affected effectively the entire world, not always at the same time, but throughout. So all the things, we stopped production on things like factories closed. We demanded more goods. We had who remembers the weird run on toilet paper, right?
COVID hits
nobody will understand. You can't buy toilet paper. Nobody will ever understand this because it makes absolutely no sense. So we just reacted to this, and obviously the government came in, stimulated a lot. So we get to this point here where look, the reopenings have fully happened. We've now cleared out most of the supply chain issues. Oh, then by the way, we have a war in Ukraine, which Ukraine produces a lot of goods. China continued some of their lockdown policies way through even into the end of 2022, maybe even to 23, depending on who you ask. So the good side of the equation got really messed up, and inflation obviously started kicking off. We had a lot of people who left the labor force. We could argue that there's some are probably good, bad, there's some good. Some people decide that, I'd just rather be at home with my kids. So I don't really need to be 2 income. Or I know a lot of people personally who just decided, I'm just going to retire. Stock market's high. I can monetize out. I'm 60. I worked with people that were 62. They thought they were going to go to 65, but they're gone, right? So a lot of the labor force is here. So what's happened is now here we are, early 24. We now have more persistent wage inflation. We're actually now seeing more services inflation. So all kinds of stuff, even from your cable bill. You still see food and energy a little bit all over the place, but we are still in this inflationary cycle.
Sure.
So what does that mean? Interest rates, as now the Fed has taken the policy, are higher. I will just say, at least again, early March, as it looks today, we had an inflation reading literally this morning. Interest rates are not coming down until there's a reason for them to. Sure. The Fed isn't going to move until there's a reason. Unemployment's at 3.9%. That's considered to be very low. GDP, this gross domestic product, this broad measure of economic output, which kind of, if you actually try to understand it, you would totally lose your mind to think that this is how they make decisions, but it really is growing maybe somewhere in the 3%, depending on, right? I mean, depending on what measurement you take at what time. If that just continues, interest rates are going to stay where they are. And they're high compared to where they were, but they're not high long-term. And I don't think the Fed thinks they're that high, actually.
Sure.
So what does that mean? Well, for the real estate industry, it's horrible.
Yeah.
By all measures, commercial real estate is in a recession, right? Sales are down, depending on the measurement, 60 to 70%. Valuations, again, depending on how you measure them, at least 10% in most areas. Some different things will tell you that this certain sector thing might be down 30%. I mean, you hear different numbers. You hear projections, oh, this is going to fall by 50. I mean, there's a lot of we're at the stage of the game where people are starting to make crazy statements about commercial real estate. But yet the stock market's high. Home prices have basically stayed very flat. Rents are kind of flat to falling, depending on, that's all market. You have to go market by market on any of those things. But, we're probably going to stay where we are. And is there a big risk of a recession? I mean, look, we have seen interest rates. We have what's called an inverted yield curve, meaning that the short-term rates are higher than long-term rates. So, the Fed overnight rate or that 1-year treasury is about 5.25, 5.3, thereabouts. And that's the only thing the Fed controls. The 10-year treasury, and I don't know what it is, more about 4.1 to 4.2, maybe gets as low as 4. It's normally not that way. Normally the longer you borrow from, per se, the higher the rate, the shorter term is much lower. Historically, every other time this yield curve inversion has happened, such we have good data to know such things, there's been a recession, usually 9 to 24 months later. We'll hit that 24-month point in June or July. So it stresses companies. It stresses borrowers. It's going to cause issues. And whether or not we can sail through this and have that, this is the big debate. Is it this soft landing,
right,
where nobody really knows what these things mean? They're just kind of like, basically, we don't really have a recession, but economic growth slows, inflation falls. And in theory, the Fed would then start lowering their rates. And the hope is, certainly in the real estate industry, is that then mortgage rates, everything kind of falls through. We'll see. I mean, inflation is still higher. So if I would say that we're probably going to keep rates higher. I've been thinking, I did not buy this whole thing in December when all of a sudden the market's exploding. Oh my God, interest rate. I'm like, I don't think they actually said that.
Yeah.
And the Fed came out and tried to clarify. We didn't actually say that. And shockingly, I mean, we'll see what the March decision is, but no one's really thinking they're going to cut rates at this point. Sure. So, if you're in the real estate business, you have to, I would just say, the better you can adjust. I mean, you have to start adjusting to that. This is maybe where we are. But this expectation, it's incredible. Like, rates and kind of the place where we were, like if we compared this, like where we were this time in 2023, they actually haven't changed that much. Not much. Yet they went up higher. They hit like 5% of the 10-year. But yet last year, everyone was just assuming we were definitely going to have rates falling. They were much more certain we were going to have a recession. In fact, all these predictors of recession hit some of the highest levels without one happening in the history of like this thing called the Anxious Index. This is a great name for the survey that the Federal Reserve of Philadelphia undertakes. Does it mean that are we out of the woods? Honestly, no, because all the things that we thought could be problematic a year ago, most of them still exist. But the economy persists on. So that's kind of where we are today.
Are you ready to go beyond the blueprint? Introducing Nexus, the ultimate game changer for commercial real estate and development professionals. Nexus revolutionizes how deals are made and projects come to life. With our cutting-edge SaaS platform, we're revolutionizing the built environment, making your workflow seamless. Vendors gain instant access to opportunities tailored to their needs, while organizations find consultants, vendors, and contractors with the click of a button. Our all-in-one mapping and deal-making interface powers municipalities and site selectors to shape the future of cities nationwide. Join Nexus today and be a part of the future of commercial real estate and construction. Visit our website now to pre-register and get immediate access to what is to come. Visit gonexus.us. The power to transform your project starts here. So with the interest rates where they are now, we've got this massive amount of debt in the commercial real estate space that's about to come due here in the next year and 2 years. So how does that look, and what's your economic prediction of, what happens in the next year or 2 years.
So, the wall of maturities or all the, there's all these phrases. And I remember this was a big thing back in post 2008 period as well. Banks have a lot more discretionary control over as to what to do with it. So like the idea that your loan is coming due in 2024, you can key in on a computer. I 24, I meant 2025. Like it's really easy to kind of kick a can. Now, in 2008, that's what they did. They called it pretend and extend, right? They just pretended that nothing was wrong. The values hadn't fallen, nothing adjusted. If you can make payments, and then they just extended the rate. Now, if your cash flows had fallen, they might have to say, well, cut the interest. They may have to make forbearance or other accommodations so that you can still make payments per se. That's really easy when interest rates were like at 5% prior to the big '08 downturn, going down to like near zero as a result. It's a lot harder today when a loan might have been issued at like 4%, and now the prevailing rate is like 6 or 7%, which is the case. Now the bank has to make a decision. Can they keep that same rate? If they raise it, does that trigger default because by increasing the payment or what? But they still have some discretionary control. The Federal Reserve, the FDIC, all the regulators, and a lot of this was law that got, they did everything kind of like on an ad hoc emergency basis post, right during the 2008 global financial crisis. A lot of it got codified into law between Dodd-Frank and other regulatory changes. So you almost can't have a big default wave without sort of the Fed ordaining it to some extent. I mean, we don't know that's 100% true. That's just it's a theory to say the least, but there's regulatory reaction. So I say all that to say if it could still be managed in a very orderly process. I don't think that you necessarily have to have massive fire sales. Now, we did see bank failures last year, right? We kind of had this wave, Silicon Valley Bank, Signature Bank, I think it was at First Republic, or First National, I was not sure. The other one you saw in the big headlines. Then there was we haven't really had a big bank headline. I think that's some of the fear that I've seen some interesting analyses that do regional banks or smaller banks have more, some of them make a lot of commercial loans, not all, but I mean, some of them have risk. If the banking sector starts to kind of roil over, then it gets a lot harder to kind of, hide all that stuff. So that's what I think people are somewhat fearful of for good reason.
Do you think there's going to be more banks that are looking to really diversify their lending after this?
I think, banks are interesting organizations. I mean, debt markets are interesting in that, they said the same thing after '08. They actually are, believe it or not, part of the reason why I don't think banks are terribly at massive risk is they actually did that. I mean, you look at the lending standards, you look at the way a lot of banks are managed, they're really not, there was nowhere near the level of, call it, stupidity that we saw during the pre-'08 global financial crisis. Sure. That said, there are banks that are over-concentrated, commercial real estate, they're over-concentrated in asset classes that or loans that are very interest rate sensitive. So, I mean, the problem with it is, and that this is something that is kind of unavoidable just by the nature of banking, is that banks inherently borrow short-term rates because you put your money in on mostly overnight deposits effectively, maybe 1-year CDs, et cetera. People don't really ever go much longer. And they lend out multiple year loans at higher rates. And that's how a bank makes profit, right? They borrow a shorter term rate, they lend out long. That yield curve thing I was talking about, where the short-term rates are higher than long-term rates, that's really bad for a bank.
Sure.
So the problem is their costs have gone up, and all the value of the assets that are based on interest rate, which includes commercial real estate debt, really includes all debt except for floating. It affects all fixed rate debt. Now, floating rate debt, right? If anyone has a floating rate mortgage, which a lot of commercial loans, a lot of apartment loans have floating rates, you're thinking, oh, well, there's a floating rate. That's good for the bank. It is if they have some caps and insurance against it. The problem is that then creates the actual risk of payment default. So though there's kind of nothing a bank can do to kind of protect itself other than just keep a lot of capital in reserve.
Sure.
Or they can maybe invest in floating rate securities. It's difficult. So the challenge is that the interest rate environment move, they just kind of have to eventually absorb it.
Right. And how does this affect? So there's a lot of things at play, right? You've got your interest rates. You've got, you had mentioned our unemployment rates at 3.9.
It's a current reading, yeah.
right? But there still is, especially in the construction side of things, there's a labor shortage, right? There's a void there. So how does this affect development?
It's huge. So actually, I mean, it's funny, the labor shortage you mentioned, this goes back to something that, an interesting, I think it's a COVID era effect. Some of it's demographic, but so one of the most interesting economic readouts that the Bureau of Labor Statistics provides, this thing is called the JOLT survey, Job Opening and Labor Turnover Survey. And for the lifetime of this thing, nobody ever really cared about it. Somewhere around 2018, a really interesting thing happened. And if you're watching the video here, right, imagine that there's a number of people, like the tracking rate of the number of unemployed persons, right? It's about probably 6 million now. I'm just somewhere between 5 and 6. I don't remember offhand. Then there'd be the number of job openings, right? So a tight labor market would be like 5 million unemployed people, let's say, and 4.5 million job openings, right? But there would be more unemployed than job openings, right? And then obviously it's not the same people. There's churn and all this. It crossed over slightly. So we're suddenly like, okay, 5 million unemployed people, and there'd be like 5.3 job openings, right? We literally had more jobs. All right, the COVID happens, and suddenly like job openings go to like nothing, like 1 million. It fell dramatically. And suddenly unemployed person spikes like, I don't know, it was like 14. That was a huge number, right? Then really quickly, it kind of switches over as all the stimulus and everything comes in. And then for multiple years, we literally had like 12 million openings to like 6 million unemployed. We literally went for a whole period where we had 2 job openings for every 1 unemployed person. Now that's fallen. It's contracted. Now the number of jobs openings have fallen. The number of unemployed people stay about the same. So it's about 1.3. Let me tell you something. That's a stupidly tight labor market. And construction, where you have a mixture of both skilled and unskilled, obviously all physical labor, you got to want to be out in the sun. You add in now you have, some of this also is, we don't have immigrations, which has gotten all kinds of messed up in weird ways, but you don't have some of the more orderly migrant workers coming in with permits per se that were, that fulfilled all those jobs. So it's a huge problem. And that's kind of why inflation is still persistent, is that, I think from everyone I talked to in the construction industry, they all say like, well, the price increases have kind of stalled out, but there's not a lot of declines. And labor, I've not heard anyone yet, maybe you might know better than I would, that said that labor costs have come in.
Yeah.
Material, come down. Yeah.
No, they have not. No.
Yeah. I mean, I've heard material costs of in some
Yes.
certain materials, some high, some of the very fancy trade work type of things. Like I think like if you're doing like steel curtain wall, stuff like this, I've heard that there's just some really crazy spikes, but some of the things that are factory based have, the backlogs have cleared at the factories per se, but the
your total price has not come down. You've seen a gap. You've seen the material pricing come down a little bit, but your labor,
of course, and your insurance and all that kind of cost gone up. Your workers' comp has gone up. So so all the different the areas, I mean, that is flattened out. So for development, I think that's kind of where you were leading. Yeah, it's really tough. I mean, you're at a point where the ability to build new anything is tough because construction costs are still very high. Market rents are soft in everywhere, maybe with the exception of retail, where you're seeing there's been shortages of retail, so you're seeing retail rents. I hate to use the word spike, but in some markets they're going up just as a shortage. Office, interestingly, really high quality office, like brand new or like the really cool, sexy stuff, is actually probably seeing rate increases. There's not that much of it, and companies that really want to have that for their workforce. Your Class BC stuff is definitely seeing something else. Apartments is the scariest one, actually, because we're building a lot of them. There's a huge rate of new supply. We were both at a conference yesterday. One of the speakers, and I'd heard this sort of anecdotally, but it was kind of confirmed from a data point from, I think, a very credible person, that some apartments here in Orlando, and I presume this is happening probably in a lot of high growth markets, apartment owners are starting to offer 2 months free rent concession. That's kind of peak concession. They'll do everything they can not to cut their rates. And the next thing is you start to see more rates. So when everyone says, oh, well, the rents are flat, they mean they're down. I mean, that's really what that means. And you're seeing more concessions. And that's because there's new supply coming, right? And it's what we're leading to is that we have this big affordability problem with housing. And so the apartment market, my own opinion, I think apartment market has a lot more risk because the interest rates affect the values. The rents, are not necessarily going to be easy to push. So some people's plan or pro forma rents are probably hard to reach. Oh, and by the way, inflation is affecting all your operating expenses, your capital expenditure. So, God forbid you have to replace a roof. God forbid you need to replace an air conditioning unit, or got your insurance costs. It used to be like $500 per unit might be an acceptable in Florida insurance cost. Now it's like $1,500, $2,500. I've heard, depending on the age of the building. So that all lowers net operating income.
Sure. And so there's a bunch of things that I want to, we'll jump to this question, then we'll jump to something else. The first question is, how has the lack of substantial increase in gross domestic income affected
like personal income,
income, right? So you look at the statistic of your household income has not really grown substantially over time, over the past really 5 years, but your GDP has grown substantially. Your demand costs are still high, and so affordability becomes an issue.
Interesting framing of that, because on some levels, depending on you look at the data, and depends what data do you wish to believe, perspective, and I realize there's even political valences and all this, but we've actually seen a lot of wage growth. So, there have been good, in fact, this is kind of an interesting thing, because sometimes historically it's felt maybe the opposite. White collar wages are fairly flat. And to some extent, when you look at the changing costs of like benefits and things like that, they've maybe felt like they've trended downwards. So people who actually really feel like their paycheck has gone down because they got like a 2% raise, but the net cost of their health insurance went up such that it kind of ate it all and maybe then some. So white collar wages have been very stagnant. We even have the threat of AI and tech and all this kind of stuff that's now impacting it. Service wages, go try to get a job at all of a sudden, delivering pizzas is a $20 an hour item. I've seen this joked about how I was at a little small group meeting I was presenting at, and someone pointed about how they saw an ad, like a $300 signing bonus for joining like a sub sandwich shop, like $300 to put turkey on bread, right? This was the joke. So we are seeing more wage gains for the lower 20% wage earner. The median where it's really painful, and I suspect a lot of the viewers of a podcast like this are going to really resonate with what I'm about to say. The most painful part about it is sort of that middle to even middle upper income set, generally working professional who is finding their cars are more expensive. They want to buy a house and they want to rent, like the ability to save and all the expenses, especially if they're having children. A lot of the childcare costs are just stratospheric on a relative. That's the thing that even affected the labor base, is that it was too expensive to necessarily pay for childcare. So, if in two parents,
stay home.
Yeah. So if you're assuming some two income household says it's not worth it, one parent decides to stay home. So that's the side that is, I think, really, really, really the most vocal and has the right to be really upset. And it's a lot of college grads that also have this student debt and things like that. That is probably the demographic that, the very well off, especially if you have a fixed rate mortgage on your house, you're experiencing inflation, but nowhere near the same. Very low income are actually getting wage increases, whether it's keeping pace as fast as the rents, and that's a little bit debatable. I'm not sure that they're jumping for joy either, but it's that middle kind of 50, like the lower 75 to 20, above 25% to 70% income band that probably hates their life the most right now, legitimately, because I think interest rate costs, because they buy cars and they want to buy houses, occasionally even use credit cards. They're paying tons more in interest, right? Which is not even really factored in an inflation measure. Those CPI measures don't really look at those things.
Right. Today's episode is brought to you by Bryce Knuth of Insurance Office of America. As a contractor or real estate owner in Florida, you've likely experienced the impact of rising insurance premiums year after year. With the challenging insurance marketplace, having a specialist who focuses on your industry is critical now more than ever before. If you'd like a second set of eyes on your current insurance program or don't have a relationship with your current broker, please contact Bryce Knuth at 407-697-6944 via call or text, or email bryce.knuth@ioausa.com. Don't let rising insurance costs catch you off guard. Reach out to Bryce today. So, last question, then we'll wrap up. So as we, have this void in the labor market, I think you're seeing, especially at the event that we went to yesterday, this tech space that's really just evolving and maturing, especially in the industry, but not only in the world, but especially in the industry. Whether it's things that impact the built environment or things that, help automate processes and procedures. What are you seeing on that side of things, and what does that adaptation look like?
There's a lot of investment into it. Tech has changed so much of what we do. I mean, look, it would be remiss for me to say that we're filming a podcast right now. I don't think the word podcast came from the iPod, which I think came out in the early 2000s. So we're talking about a medium that be played on YouTube and all these streaming channels or Spotify. These things didn't even exist that long ago, and yet now this is a dominant form of communication and media. Tech always changes things. It's very high impact. It's just sometimes it's very, it's hard to tell what's going to happen. So I think a lot of companies, they recognize they want to have more of their data in the cloud. So a lot of data analytics, they realize they need to get insight. So you see a lot more data analytics people being hired, a lot more software being purchased that can handle this. They're trying to automate. I think everyone, is trying to achieve cost savings with AI, efficiency gains, productivity gains. There's a lot of people who are, I think, in the built environment, the big thing is now getting sensors and getting systems so we can have predictive maintenance so that, the air conditioner, air handler units can tell you they need fixing before they break, those type of things. So you're seeing just a massive, a lot of money, a lot of investment into it. There's going to be winners and losers. And I think that, in fact, I think the hardest thing, I have this discussion with property manager, people very technical, is that I want to be a leader on this. I recognize that if I'm not tech, it's like, and you're a little bit younger than I am, but I remember in the 90s when the internet was a thing, right? I had dial-up, starting with dial-up and everything. It was actually a big discussion among companies. Should we have a website? Was an actual discussion. Right. Nowadays, if someone starts a business, the first thing they do after they think the name is secure, is they go buy the URLs. Literally the first thing you might do is launch a website before you've done anything else. And literally in the 90s, we're going to have a tech forward strategy. We're going to have a website. Literally was a thing. And now, right, nobody doesn't have a website. I bought URL names for my kids' names when they were born to secure them so they could have them, right? I think that those so it's going to keep happening. I don't entirely, I think a lot of AI automation, I think a lot of, just software things. I mean, we power things through our phone, through our iPads. I mean, this is just how we do business. And candidly, the real estate world is 30 years, is just behind. Banking leads it. Real estate always acts as a laggard.
Sure.
And you're seeing that now. So I wish I couldn't, I will not even try to tell you what I think I'm not going to try to pick the winners and losers in it. But I think a lot of people are very afraid that if they're not forward thinking on that curve, they are going to literally look like the company that doesn't have a website. Right.
And so I guess to piggyback before we wrap up,
yeah,
because you're seeing there's a generation that's about to start sunsetting, right? And there's a new generation that's coming up. Do you think as that generation shifts, there's going to be a higher tech adaptation with the newer generation, especially in this industry?
No question about it. I mean, the expectation. Look, I mean, I'm old enough to remember getting my first cell phone when I was in college. Nowadays, it's like people in elementary school. My 2-year-old daughter, she'll sometimes come and press my computer screen, if she can touch it, she cannot understand a screen that isn't touch interactive. So I think every generation just has a new baseline of technology. So it becomes expectant where, no offense to any old person or anyone, when you decide everyone can decide what old is, but people are like, wow, look at this is so cool. What do you mean? That's same we're being marveled by electricity. It's wow, your house has plumbing and toilets that flush. I'm that was new technology, right? At some point. So I feel that yes, every the level sets, and I think be it millennials, certainly Gen Z, they just do not they don't interact with things that don't have apps. Sure. I mean, by the way, communication wise, texting is phone calls might go away. I mean, legitimately, these things will become completely standard place. But yet they were completely unthinkable sometimes 23 years. So I expect that to keep happening. Absolutely. And yes, this next generation this new generation, especially Generation Alpha, the one that followed the Gen Z kids, they were born with iPads before they went to elementary school.
Sure.
And there's absolutely no choice self-driving. They're going to adopt, they want a car that's a group that probably won't understand a car that isn't self-driving.
Right.
That generation is already probably being born.
Sure. That's great. All right. So we're going to jump into some rapid fire.
All right.
First question. What does success look like for you?
Personally, for me, being I think, content, but also feeling that I have accomplished things that other people would recognize.
Good. What's something that most people don't know about you?
Something most people don't know about me. I love photography as a hobby, and I think if I could just wander the world taking interesting photos if I could tell all my stories through photos without words, I think that'd be amazing.
Yeah. What advice would you give your younger self?
Don't worry about things. The things that you think are really bad are actually really good for you.
What scares you?
The unknown.
It's fair.
Yeah. The fact that I can't control the future, and I wish I did.
Yeah. Who's your inspiration?
Wow, that's a good question. I think in a weird way, my own inspiration at this point is I have to say my kids. I mean, I think that I think all this is true of lots of, I think you're sometimes more running away from things and you are running towards things. But I think once you have kids, suddenly you do realize that like there's a continuation and like, that like you're not just letting yourself down
Sure.
anymore.
Sure. What's something new happening in your life right now?
I mean, working, so both my role with Fordham University is fairly new. What I'm doing with Magnolia Hills is kind of new. So I think, I moved back to Orlando, so I'm doing this semi-remote, all this fun. So in some ways, just my whole life is a bit new and a reset from what I was after spending 6 years in New York. So that's plenty of new is going on in that regards.
Last question. If you had to ask or tell God one thing, what would it be?
Thank you.
Thank you.
Yeah. I'll add on to that. I think that this goes back to the same advice I give to myself. I think that the older I get, the more I understand why things happen, the like things seem less and less random. And I think that experiences, including just huge disappointments or things that went poorly, or wondering why things didn't happen at a time like the time, like I'm more sort of convinced in sort of the role of divine orchestration in my own life as it plays out. And to some extent, I'm like, so major thank you. And I'm kind of excited to see how the story ends per se, right? Like I want to watch the rest of the movie,
right?
Right? Because I don't know.
Yeah, right. Josh, well, man, I appreciate you coming on. You shared a lot of great insight. Do you want to leave anybody with anything before we head off?
The world is, I will say this, because we talked about a lot of the fearful things. And I think right now, if you turn on the news, there's a lot of legitimately bad stuff. I remember finding a book at a used bookstore. I wish I had bought it. It's like 20 years ago. And it was like about all the future calamities and problems of the world written by like a futurist. And it was written like in 1980, literally. And I'm thumbing through all these bad, like, economic problems, environmental disasters, all these things. And it's like 20 years plus later, I never heard of a single one of them. Like all these things that people were freaking out about in the 80s, or at least this author was, I don't think anything, or if they did, we solved them, or they were meaningless or supplanted by bigger worries. So whatever you're worried about, and realizing that like in the noise of the day, just realize that like you could go back at any point in time. There was a doomsayer, there was something bad, this thing was going to end the world. I mean, nuclear war. I mean, there were kids jumping under desk, right?
Sure.
Thinking that was going to protect them from a nuclear bomb. Okay. I think some of our COVID rules will look like I wore the mask into the restaurant, then took it off to eat. I think that'll be the same thing. But just, don't worry so much. I think that's the main thing, is that when you, and if you take a really long term of history, this is a quote that I came up with in West Speech. I'll use, so I'll leave you with this. The world keeps getting better and better, and I can prove that with data, yet we think it's falling apart.
Sure. That's really nice. That's good. Yeah. That's a good quote. Yeah. Well, Josh, man, I really appreciate you being on, and I think you left everybody with a lot of really good insight, and hopefully this economy shifts back and we see an upward 2025.
It will. Well, it's always it's never an if, it's always a win.
That's right. Beyond the Blueprint Podcast, I'm your host, Branson Bowen, and this was episode 2 with Josh Harris. Thank you for joining. Make sure you like and subscribe to the channel. We have a great season 2 lined up with some amazing guests. We'll see you soon.